All right, now having learned few basics about the bond, such as the coupon rate, face value, and the maturity of the bond, we are now going to study something more interesting about it. These bonds are literally the pieces of paper. Okay, this is like the yellow paper that the government issues. Now, if you have bought this piece of paper from the government, there are two options. Either you can just hold on to this paper for the next 10 years, you get your coupon every year, put it in an envelope and get rupees 10 every year, and finally at the end of the 10th year you get back your return. Or the other option really is that you take this paper and you trade it with somebody else. Okay, this is what is called as a secondary market trading for government bonds. There is a sizable market in India where these papers are also traded. That market is usually populated with players like commercial banks, insurance funds, pension funds, mutual funds. Of recent, the retail investors have also got a direct entry into this secondary market trading that happens. In the primary market, of course, where you have to bid for these government bonds at the initial place, there is already opportunities that are available through apps like Zerodha, etc. Many of these brokerages now list the government bonds that you can bid for. That is at the primary market. But the secondary market dealing is something that is still quite relatively new in the Indian context. So similar to the stock market, there is this bonds market where you can buy and sell these bonds. Now let's say there was this bond that was probably a rupees 100 face value bond with a 10% coupon. And the idea therefore would be that this bond will get you rupees 10 every year, and at the end of the 10th year you will also get your rupees 100. But now suppose that if the same bond is being sold on the secondary market at a discount, let us say it is being sold at a price less than 100, it is being sold at a price less than 90. We will get to the why and how it can happen, but suppose that that piece of paper now is only being priced at rupees 90. In this case, if you were to buy this piece of paper, then your investment would just be rupees 90 and your returns would be still rupees 10. They would still be fixed through the year. Why? Because the coupon that you are going to tear off from the bond and send to the finance ministry has those things printed on it. Okay, that is an important thing to remember. That thing is printed, that doesn't change. So the finance ministry, when it receives a coupon, it doesn't care whether you bought the bond at 90 or some other price. It will just look at the coupon, and if the coupon says that rupees 10 is due as interest, it will just put rupees 10 in an envelope and send it to you. So you will still get rupees 10. But since you bought this particular piece of paper at rupees 90 and not rupees 100, your return therefore on the initial investment is equal to rupees 10 divided by 90. So that's equal to about 11%. That 11% is different from the coupon rate of 10%. This 11% is what your return on the bond is. This is what the bond is yielding to you. This is called as the yield of the bond. Similarly, if you were to buy this bond at a premium, let's say rupees 110, then your return would be rupees 10, that is fixed. You know the reason why, because the coupons are fixed. So you're still going to get interest payments of rupees 10. And the principal, the initial investment that you made was 110. So your return on this particular bond will be 10 divided by 110, and that's roughly equal to 9%. In this case, the bond will yield you just 9%. So this is an important concept. The yield of the bond can be different from the coupon rate of the bond. That's number one. Number two, if you really look into this example and stare at these numbers that we have taken, the initial price of the bond was rupees 100 and the coupon rate was 10%, and that was also the yield of the bond if the bond was being sold and bought at rupees 100. But if the price went down to rupees 90, then the yield went up from 10% to 11%. The coupon rate still stayed the same, 10%. And conversely, if the price went up to rupees 110, then the yield went down to just 9%. So you can see a relationship here. The yield of the bond and the price of the bond are inversely related. If the price of the bond goes up, the yield falls. This is another important relationship that you must remember. Now, what is the big deal about this yield? Okay. The big deal about this yield is that the yield is a market signal. It is basically the true cost of borrowing that is happening in these bond markets. And when central banks or economists and everybody else in the finance sector talks about interest rates in the economy, they often mean yields. They don't mean coupon rates. Okay. Now, what is special about this government bond? This government bond, just if you take a step back, is being issued by the government. That is as safe gets. Okay. This is the most secured piece of instrument that is there for you to save your money in. It's the most secure thing because the government will not go bankrupt. Some countries, yes, that happens. But for the larger part, the government promise is the most secure promise. And the fundamental reason is because in order to fulfill that promise, it only has to send you back this other paper that its own arm, the RBI, issues. Okay. So you're literally transacting in two kinds of paper which are both issued by the larger government of India architecture, the finance ministry and the RBI. So your money is as safe gets. Okay. The rate at which, the prices at which this paper is being exchanged in the secondary market is a signal of how money is being priced in that market. Okay. This is very important to get this intuition. The other things are just technical, but the intuition is that the way this paper is getting traded, if a 100 rupee bond is being traded for rupees 110, it means that the yields have fallen down to 9%. If the 100 rupee bond is being traded for rupees 90, then the yields have gone up by 11%. Right. So this yield is basically telling you what is the rate of return that people are expecting on their money when they are basically exchanging their money with bonds. Okay. It gives you a sense of what the borrowing costs in the markets are, and then things will become a little bit more clear when we talk about these yields and interest rates moving forward. Okay. Now, in the discussion so far, I never really told you why would the bond price go from 100 to 90 or from 100 to 110, right? Now is perhaps the time to get into that. Who decides whether the price of the particular bond should be 100, should just stay at 100, or should go up to 90 or 110? The market. That's a simple answer to that. Who is there in the market? There's a supply side and there's a demand side, right? And the markets will determine what the price should be. Who are these market players? I've been repeatedly mentioning them. The central bank could be one of the players. The finance ministry could be one of the players. The commercial banks could be a player. Insurance, pension funds, mutual funds, etc., could be the players. Even retail investors could be the players in this market. So all of them are collectively busy transacting this very secured piece of paper with money, and the rate at which this transaction is happening is what is captured by the yields. Okay. So when we refer to yields, we will usually refer to them as interest rates. Okay. We will synonymously use the word yields with interest rates in the economy. It will become clearer when we talk about how yields and interest rates and RBI interest rates and bank rates are all related. But the most intuitive way to think about it is that all we are really talking about is money being exchanged in the with the most safest instrument that's available, and the true cost of that exchange is what is captured by this yield, which is being synonymously referred to as interest rate. So markets are determining this interest rate. Now, some of you may ask me that, well, what is RBI's role here then? I thought that the Reserve Bank of India sets the interest rates, right? You read it in the newspapers that the Reserve Bank of India has set the interest rate to something. But if I'm telling that the market is basically discovering this rate by itself, the price and the quantity in the supply demand framework, then where does RBI fit in here? The answer to that is that the RBI influences these interest rates that are being discovered in the market by setting the base rate, the policy rate, which is also called as a repo rate in the case of India, and we will discuss what repo rate is. But think of it in this way. You've seen a dog, right? And there's a famous idiom which says that the dog wags the tail, right? But it's almost like in this case, RBI wags the tail, and the entire dog, the entire body of the dog, which is the entire ecosystem of the finance, financial intermediaries, and the monetary system, etc., they all seem to move with just this. So RBI sets the policy rate, and somehow that policy rate cascades through all of this market, and the market discovers and prices these bonds at some yield. And these yields, these interest rates in those markets seem to anchor with the policy rate that the RBI sets. Okay, that's the larger intuition of it.